Then what I was able to do is get people on the bus that that was the most important thing to them as well. I couldn't teach people how to be caring. Once I was able to do that, I realized that it started, Tech Guru started to get a momentum of its own, and I wasn't always having to get people realigned, and micromanaging became a thing of the past because everybody was, quote unquote, rowing in the same direction and doing things with those same values, and that has been one of the greatest things to helping us see the growth that we've experienced lately. Thank you.
Great, thanks. Kevin?
I have to second that, actually. That was what I had written down, but really I said it starts with the people. What we've seen from internally at Renter's Warehouse is the reason we've been able to sustain such large growth, fast, rapid growth, sometimes tripling in a single year in size, is the people and fitting the core values and the culture in which you've created for the business, but also making sure you share the vision of where you want to go. We've touched it on the panel already of having that vision and having a purpose and a plan to get where you're going, but being able to filter that down throughout the organization so that everyone is working for the greater good of where the business is going, and finding team members that are willing to maybe make some personal sacrifices for their professional development for this year so that the organization can meet its goals and its mission on where it's going. And so it really does start with the team, having that shared vision and, to your point, rowing in the same direction to get to the end goal, and communicating that all the way throughout the organization. I see a lot of businesses that communicate that really well with their leadership team, the management team. We're going to do this year. But the administrative people at the entry-level positions have no idea what the goals are for the company, and actually sharing that throughout the organization really gets everyone to buy into ownership of that goal and strive for that and make it successful to get there.
Great, thanks, Kevin. Tom?
Common characteristics of managing growth well. Owners and leadership manage the business, not the other way around, which we often see in struggling companies. You've got to have professional management and processes. Entrepreneurs typically try to manage their business emotionally. And as you start to grow fast, you're going to have to move to a more professional management structure. Got to remind the owner that there's two checkbooks. There's the personal checkbook and the business checkbook, and when you start to mix the stuff together, all of a sudden your numbers become meaningless, and so you can't manage that rapid growth. And lastly, as you really start to grow, the owner needs to make himself disposable. You got to start to build a management team that can do the things the owner currently does so that the business can operate without the owner there.
Great. Staying down there on that end and kind of working this way, shifting gears from kind of the positive characteristics, looking at it kind of more from a negative perspective, what are some obstacles to growth that you've seen more often?
Probably the biggest obstacle is underestimating the infrastructure you need. Your infrastructure has to be scalable or you will implode your business. And I go back to my previous answer, which is when there is too much reliance on the owner, you don't have a business anymore. You have an owner. And so if your owner wears all the hats and no decision can be made without him or her, your business is just completely fragile and you will not be able to grow.
Kevin?
Biggest obstacles I see for corporate growth is, quite frankly, confusing and overburdensome government regulations. Sorry if there's any government regulators in the room. But that's what we run into. I'm in a highly regulated industry of real estate and the things that come along with it, so I deal with this every day. But it was definitely top of mind when you just asked the question. And if anyone has a solution on how to get around that, come find me after the panel. But I'd say that that's really one of our largest obstacles we're facing, and it seems we have administrations at local, state, and federal levels that want to continue to push harder on business owners with more regulation, not less, and hopefully we can turn that around.
Great. Dan?
Thank you. You know, I would say that in my own experience, the shift in my mind from thinking about Tech Guru as a technology company to thinking about it as a marketing company that just so happens to be really great at technology was a shift that changed our growth trajectory significantly. And what I mean by that is educating and sharing what we do, and becoming thought leaders in our world of small business, and making an impact that way has led to significant growth in the business. And so once we perfected all the operations of the company, our job wasn't really done at that point. That helped bring in clients, but didn't give us the growth that we were hoping for. But instead, reframing our what we are and what we do as sort of a marketing company that building on that, learning how to do marketing, for example, that helped a lot.
Great, thanks. Todd?
Yeah, I think for an obstacle, I would pick up on a couple of themes I heard Tom hit on that I really agree with. I think one of the main obstacles a lot of times to managing growth successfully is emotional. I think it's the emotions of the business owner, entrepreneur, manager who has worn all those hats for a long time. And the tricky part is it used to be a source of pride for him or her. And it used to, even for people on the team, it was comforting to know that the leader was all in and could do everything and knew all parts of the business. And at some point, it evolves from where that's a source of pride and comfort to where it's scary. It's scary for everybody because they can't see the scalability of it. They don't understand how they're going to be able to keep growing. And then it's the emotion of letting go and which to let go. Because most of the time, I think if the owner entrepreneur is honest, he or she will say they're not the best at everything. And so you would hope that to get them in a spot where they can focus on what they're really good at, because that's probably going to be the most satisfying. But it's hard to let go, and it's hard to relinquish control. And as a bank, I know we worry about that when we see that, because we do want to understand the professionalism and that there is a real business and not just a talented entrepreneur.
Okay, great. Thanks. Scott?
You know, to follow up on the theme, what Tom and Todd said, you know, it's the founders, I guess, not recognizing that they have limits on what their skill sets are, and the skill sets that of the entrepreneur that got them to a certain level may not be conducive to growing the business to that next level where you need more processes and procedures or some type of a management team in place. You also, one of the obstacles I've seen is accessing capital. What I've observed is at times there isn't the recognizing the importance of developing relationships with your banker early on in the business process and before you need or want the money, because when you need it, you're likely not going to get it. And if you can develop a relationship with a lender and they can see how you've grown the business, the type of character you have, and your vision, that counts for a lot. I've seen that quite often with clients of mine, and I don't know if you have anything to comment on that.
Oh, you took. I can strike out part of what I was going to say later.
All right. Anything else you want to add to that, or
no? Just you know, again, back to developing a roadmap and needing to communicate that to the rest of your employees, your team.
Okay. No questions from the audience. You can ask questions. I got one right here, front row.
The theme that we're hearing is systems, is kind of what I'm hearing here. So you need to, if you really want to take that business to the next level, you need to have those systems in place, the staffing in place, so that it's not just you running the business. What would you say to that entrepreneur who can't seem to get there, that says, I get it, but I don't know how to take it to the next level, to get those systems in place, to be willing to just back up and walk away from it and get it all laid out there? Because I think that's a huge roadblock for a lot of successful entrepreneurs, that they just can't figure out how to let go.
Can I start real quick? Just because I've had a conversation recently just along those lines where owner-entrepreneur had come to grips with relinquishing control, but we're just sort of paralyzed with how to do it. And the key fork in the road is kind of renting or owning, right? Are you going to have a short-term project-based consultant that helps you get over the hump with some of the things that need to be done, or are you going to take the plunge and hire a long-term employee, a full-time employee, to solve permanently the staffing? And that is a hard decision. I mean, I think that one thing I would recommend is, maybe a little bit to Scott's point, is your banker has some interesting perspectives, and they're working for free. They're not charging by the hour. So I would encourage you to call your banker, because they've seen both done well and seen both done poorly. Not all consultants are created equal, and certain approaches to solving it with a permanent staffing position are better than others in terms of describing the role and the background of who you're, but that is because it's hard to see the clear business case at times. Even when they've come to grips emotionally with relinquishing some control, how to do it can be difficult.
Yeah, most entrepreneurs are control freaks to start with. So what we typically do is sit down with the entrepreneur and say, okay, let's put down a list of everything you're doing. And then let's rate them what you like to do best and what you hate to do. And when they get done with that exercise, you find out that everything at the bottom of the list is not getting done very well, if at all, because they hate it. And so that's where we start with, this is where you start to need to think about your first hire, your first addition of the management team. So if it's, you're harmful to everybody dealing with people, get an HR person in. If it's, you're great at sales, you're a good engineer, but you can't deal with the accounting, then hire an accountant. But so that's what we do, is let them do what they like to do, and because it's usually what they do well. And I would reiterate his comment about the banker. Ask your banker. We always tell clients, your banker is your best friend. He's not your enemy. And you don't ever lie to your best friend. So sit down and talk to them. They're going to give you advice, and yes, they won't charge you because he's charging you on your loan every day. While he's out playing golf, he's still making money. The rest of us have to do it for him.
I can see Todd's got a few hires for his marketing department up here. Yeah, I got a question back over there.
In this day and age of technology, can somebody speak towards the organization of a business and the use of that technology so everybody can be on the same page? What are some of the tricks of the trade that you use as far as technology?
I'd be happy to field that one. Okay, so the new generation of workers like to work on their own terms. I'm assuming that's probably what you're alluding to. So there's some powerful tools out there like Google Docs and Google Drive for communicating and collaborating in real time on documents from anywhere in the world, and we encourage the use of those tools. Dropbox allows you to sync those files across multiple computers. And then we also really encourage our clients to dump their servers and focus on apps and tools like CRM software that is based in the cloud and has a mobile app for that. And chances are, if there's a mobile app, the next generation is going to want to use it and collaborate. And then there's other kind of a new wave of tools which are quasi-chat, but it's like an internal Twitter for your organization that can keep everybody on the same page. So those are a couple of things that we're doing to help our clients keep everybody in sync.
Oh, okay. Yeah. Can you speak up a little louder?
He doesn't have a very loud voice.
Mm-hmm.
With John and his business and trying to find the best
Oh, yeah.
way to help us. And I see a lot of programs out there.
Oh.
The-
What are some of the ones that are easy and
The question was about CRM software, and kind of, I was going to shift the panel now to kind of little verticals for each of these respective categories. So why don't we just turn that into Dan, maybe talk about CRM, maybe talk about some of the other kind of hot buttons that somebody should be looking at just in broad terms.
Thank you. Thanks for that great transition. So there are a lot of great tools out there. I'll name a couple. One of my favorite ones, and the one that I use, is called Nutshell. It's a easy to use, not cumbersome tool that helps also provide us some quick insights without having to learn how to generate reports. But here's the great thing about these tools. A lot of them have free trials that you can just go and sign up and start playing with it and see if it works for your workflows. You can put a little bit of data in there and just play with it and try it out. You know, Salesforce and things like that, you know, that's kind of the name brand one. But that tool is also kind of cumbersome nowadays compared to some of these newer age, social aware CRM tools that will connect with LinkedIn and connect with your other social media accounts and even connect in your email. So think about the other tools that you're using already today. Are you working with Office 365 or Gmail? And look for another piece of software that is sort of made for or made to work with the other tools that you already have, so that you can also gain efficiencies by not having to double enter information. So when you have a communication with somebody on email, you can automatically tag that contact and have it be added to the history of that contact in your CRM software. So those are the things you can look for, and don't settle for anything less. Double entry nowadays is a thing of the past. Similar, yep. The question was, is Nutshell similar to Basecamp? Basecamp's a project management tool that's out there and completely web-based. In that regard, it's similar, but again, very much social with your colleagues. It's all about collaboration to get a better result by working together.
Some internal comments here. What about user experience? What might folks think about as far as making a consistent and solid user experience for their customers?
Well, for their clients, making sure that it's, you know, one thing that I always suggest is consistency in how folks, how your team set up things like signatures, because at the end of the day, you want to just have one brand. You don't want to have everybody using a different email signature or a different set of forms. So one thing that we do is try to make it very easy for our team to use consistent fonts and colors to make sure that every experience our clients have with our team is a branded experience. So if a client is using, let's say, some kind of client portal from us, we ensure that it's branded and has our logo and things like that, so that every experience our clients have is consistent and branded, and they know it's a tech guru, high-quality experience.
And how about snags? What kind of problems might people run into on the technology front?
Yeah, thank you. So things that you can run into that can cause headaches for you nowadays are generally malware and viruses still. The key thing, just yesterday, I got an email from one of my LinkedIn contacts that was obviously someone hijacked his LinkedIn account and sent me an email from his LinkedIn account trying to lure me into clicking some link. We see a lot of this. Make sure to use good passwords that have, would be not dictionary-based words, and don't include your kids' names or your, home address or things like that. It doesn't have to be so cryptic, but just a couple things that, people really like technology when it's working. So the thing that I always recommend is take a few minutes to understand how to use these tools, watch the video, and then another thing that is available today is cloud-to-cloud backup. So you might say, well, now that we're using this Nutshell CRM, well, who's backing that up? Generally, you're at the mercy of Nutshell to make sure that their systems are backed up. And of course, their name is on the line. They want to make sure it's backed up. Now there are inexpensive cloud backup services that will back up your cloud-based email, cloud-based CRM, so that you have a backup and continually own that data. And then I'd always just make sure that any software that you buy or invest your time in, you can get your data easily back out of it. So that's a thing of the past as well, where you buy a piece of software and you're kind of stuck with it because you can't get your data back out. Like, I don't know if anybody used like ACT, you know, that's kind of CRM software that you used to install on your computer. Oh man, good luck getting your information out of that. You really couldn't. Your notes, you couldn't get them out very easily. So keep that in mind. Data portability is the terminology that you want to look for when you're reviewing and researching software tools for you and your team.
Okay, last question on the technology front. How can somebody in the audience tell that they've kind of outgrown their current technology or service provider?
Well, generally it'll be pretty obvious because things aren't working. Employees are complaining of, here's some keywords to listen for, duplicate data entry, rework. Anytime you're doing a manual process, those are keywords to be listening for. There are ways to automate, simplify, and streamline nowadays that don't require you to be a programmer. I just worked with a client over the past month or so, setting up an automated recurring billing program so that when they have new clients come on board, their credit cards are billed automatically monthly. They currently were doing this manually. They had no idea that there was a better way. So a lot of times just asking or bringing these things up that you may have just assumed there's no better way to do it, chances are there is. Ask your technology expert if there's a better way, and chances are there might be. A lot of times these apps nowadays, the new thing is software as a service, monthly cost. There's no more of these big upfront capital expenditures to invest in these softwares. A lot of times it's just some relatively low monthly cost. So I helped this client automate this process, saving hours a month, several hours a month, and this platform is, you know, relatively low cost, $100 or $200 a month. So the other thing is value your time and the time of your employees at the true cost, and then you'll see the savings relatively quickly from automating.
Great, thanks, Dan.
Thanks, Rick.
So to some, technology can be kind of a black box. To others, the legal side of things could also be a black box. So why don't we change over a little bit to Scott's world. Scott, help folks understand kind of the types of legal entities that are out there and whether or not they can affect what they might do from a growth perspective.
Sure. When organizing a business, it's important to give consideration to the type of entity that will be operating from the legal and the tax status. And the primary legal entities that provide the limited liability statutory protections are your corporations, your LLCs, and your LPs. Now, there are tax considerations, and I'm going to just focus on the corporations and the LLCs. Corporations can either be taxed as a C Corp or an S Corp, and your LLC default tax classification is partnership, but it can elect to be taxed as a different entity. So if a business intends to expand and finance growth through outside investors, you're usually going to want an entity with pass-through tax classification, such as an S Corp or a partnership / LLC. Now, this is really important to involve your CPA in the process because they're going to provide invaluable insight into the other tax considerations that come into account with your operating business. But you know, your S Corps, they have the pass-through, but they have limits on the benefit there and its ability to be a good vehicle for accepting investors. For example, they're limited with 100 shareholders. Generally, the shareholder must be a natural person. There is no allocation of income, special allocation. It's all pro rata of income and losses. So you can't do special allocations for investors that wish preferred return. Now, an LLC taxed as a partnership, you have a lot more flexibility. You don't have the limit on the number of members. You can have special allocations built in, preferred returns to your investors, and it doesn't have to be a natural person. In many cases, you have investors using outside vehicles such as LLCs or LPs to make the investment. I guess
All right. What about corporate documentation considerations when you're thinking about changing the ownership structure? Where do you go from a documentation standpoint when you're moving, say, from your single to multiple owners?
Yeah, moving from a single to multi-owner entity, that's a real big change. And what I recommend to my clients is to take a look at, really taking a look at their corporate documentation to date, making sure that it's updated, and looking at the types of documents that have been filed, such as your articles. In many cases, your single member entity will have just filed the articles from the Secretary of State, which are adequate to get the business started, but don't have specific terms in there that really are conducive to multi-member entities. And I guess the most important document is a buy-sell agreement. A buy-sell agreement is absolutely critical to have in place for a multi-member entity. They provide a roadmap for upon the occurrence of certain events. So if a member dies, becomes disabled, goes into bankruptcy, is a divorce, how's all that handled? If you don't have that in place, you might be partnering with somebody you really don't want to partner with, such as the estate or the heirs of your former partner, a bankruptcy estate possibly. It really provides a protective mechanism for the continuity of the business, and that's really important. And also, when you have the agreement, then you need to fund it with some type of either life insurance, a sinking fund, or a combination of the both. I worked with a client on an individual matter who owned a business, and he valued it, he owned 90% of the business, valued it at about $10 million. So maybe it was worth 8. And, you know, he had a buy-sell in place, and he wasn't funded with any life insurance. And so he was very, very resistant to the concept of funding this with life insurance. And we had a discussion, and I was pretty frank with them, and I said, look, if you die, you're shifting the risk of repayment to your surviving children and your wife in this case. And he said, well, you know, the business can afford it. And I said, well, you're asking the business to pay back over $7 million in 5 years. How are they going to cash flow that, take into account growth and research, and be competitive in the market? Well, shortly thereafter, he ended up buying some life insurance. So that's one main document.
All right, so last question. What should a business owner answer, or are there other legal questions that they should consider when they're looking at expansion plans?
You know, I guess part of it is how are you going to fund the expansion? Are you going to use traditional lenders? You're going to go venture capital? You're going to look at accredited, unaccredited investors, really to understand kind of the process for that and the requirements, especially if you're looking at accredited or non-accredited investors as a means of funding. If you're expanding into different states or countries, really understanding what those laws are regarding potentially, you know, if you're going to be opening a business, labor, permitting, if you have special regulations that might apply to your business, such as sharing of profit with non-licensed individuals. Certain businesses are prohibited from sharing profits with non-licensed members, such as in the medical profession or the legal profession. If you're not licensed, you can't be an owner of a law firm or a medical firm. And if you're going into some states that have that prohibition, you better think about that if you have non-licensed owners. Also, you know, if you're bringing on new employees, have you got the proper agreements in place to protect the business interest? Do you have confidentiality, non-solicitation agreements? Potentially non-compete agreements? Those are some things to think about. And then what's your exit? Is your expansion that you're undertaking and the plans that you're doing, does the plan provide a way for you to get out? What does that look like? And the exit usually is a runway of a number of years. You just don't turn the switch and say, I want to sell my business. It's a plan to get there.
Okay, great, thank you. You talked a little bit about funding as part of your answer on what to think about from a legal perspective. So with that as kind of a backdrop, Todd, as our banking expert today, I'm wondering if you've met with a prospective borrower, their team, you've had them into your offices, they've met your group, they've given you a request. What do you and your team actually do when they leave, and you kind of, you know, pull the curtain and you get back there and you talk amongst yourself? So what actually happens back there, and what can they learn? What can they learn from that?
Rick, that's highly classified. You know I can't talk about that. I'm just kidding. We'll look behind the curtain. So it's true. I mean, we do. It's very common to kind of debrief. We've just met with business owner with a growth story, and the one common denominator I'll say is it is almost always a good story. I mean, it's, you know, you hear a business owner who has cleared the first hurdle of owning and running a business, which is there's actually demand for the product and service I'm selling and I'm growing. And they are excited. They are very good at telling that story. It's it's contagious. I mean, I can tell you, it's like we've been at an Amway convention sometimes. We want to go and sell for them. And so we try to step back and say, okay, one of the first things we do is there more than a good story, right? Is there something, is there good information that backs up what we just heard? I was reading Upsize magazine actually from last year where they had excerpts from one of these panels, and one of the panelists for that event had a quote that said, the best managed companies have the best information. And I think that's very true in my experience. So part of that is sizing up the management acumen of who we just talked to with the quality of their information. But part of it is just looking at the financial statement quality. Does it reflect consistently applied sound accounting principles and numbers that we can rely on? Is there upside and downside scenarios presented? You know, one, I think, common mistake is the old hockey stick projection with nothing else. And I think that it's just prudent to be prepared. I mean, a bank in their underwriting has got to sensitize the financial information anyway and talk about what is management's case, what's best case, and what's a downside scenario. So you're helping us connect the dots, and I think it's a healthy discussion to say, okay, your business is growing rapidly right now. What happens if that tapers off, or what happens if it has to shrink rapidly? How do things look? How does the business behave? That's going to help your banker. And I would say a related point here is to be prepared for questions and not be offended by questions. This isn't that the bank is being Debbie Downer and doesn't buy what you're telling them. It's, I think, just look at it as a healthy exchange of ideas and gathering the right information to make a good decision. So that's one, is there more than a good story? I would say another theme that we tend to talk about behind closed doors is what kind of growth are we talking about? Is it limited to top line growth, or is the bottom line growing as well? And, again, there's a tendency, I think a lot of business owners, entrepreneurs focus on top line growth. That's what's exciting. But as a bank, the repayment of our loan isn't necessarily from the next marginal dollar of sales. It's from persistent, consistent profitability of the business, from the operation of the business. And so we pay attention to margins. We need to understand the cost side of the business. And how is the growth occurring? Another question is, what kind of customers are being gathered during this period of rapid growth? Are all customers the same, or are you gathering the right customers? Is somebody worried about who's a profitable customer and who's not? Because we've seen situations where, you know, the growth is occurring with the least profitable type of part of the business. Another question relating to customers is, what do your existing customers think about this rapid growth? Is that good for them? Or are you gaining 2 new customers but losing 2 old customers because the growth isn't good for them? Just getting behind the growth, understanding its impact on the bottom line. There's almost always some kind of investment. We've alluded to this earlier on the panel. You know, the growth is necessitating upgrades in staffing, in systems, in infrastructure, technology. What is the payback period and what's the return on investment of those capital investments? And just bottom line, does the rapid growth make you more or less creditworthy in the eyes of your banker during the term of our loan? You know, that's a key question. And by the way, it's okay if the answer is it makes us less creditworthy, because that's sort of understandable. But it may impact the kind of capital that you're seeking. What you really need may be a mixture of some senior bank debt and some growth equity, or a different type of capital to fund the growth. So those, I guess, Rick, would be a couple of the themes we tend to hit on behind closed doors.
All right. Not that he would divulge it, but if anybody had a question about the behind closed doors part, now would be your chance. All right. So you touched on accounting, information. So I'm going to jump down to the end and touch base with Tom, who's L. Harris Partners, works on that side of things. What should an owner plan for as far as managing their growth and then getting into the accounting and information flow? How do they monitor and measure things, and how does that tie into how they might manage their business?
The best analogy I could give you is it's Sunday afternoon, it's sunny, and you're going to drive from your office to your house. How much thought and information and planning do you need to make that trip? And most of us could probably do it in our sleep. You might look at the speedometer, but probably just hit cruise control. You don't even check your mirrors because it's not busy. Now you're going to rapidly grow your business. So I liken that to whether you've got a pilot's license or not, you're going to put your entire net worth in an airplane, and you have to fly to rural Georgia. And all of a sudden there's a whole bunch of dials in this dashboard, and you better know what they mean. You know, you need to know airspeed, and you need to check that compass, and you need to know the attitude. I mean, where am I at compared to the horizon? And if you're making turns, you know, what's the turn indicator? And better check oil pressure. And, you know, it'd really be nice if you just had somebody who'd done this before to sit in the right seat, just in case you run into a little problem. It's the same thing when you're rapidly growing a business. You need to measure the right information. You need to check those dials constantly. And it's always good to have somebody who's been through this. And so you have to look at what is driving the business. What are those things that drive not just growth, but profitability? You know, it's drive for show and putt for dough. It's revenue for show, and it's cash flow for dough. So you've got to keep your eye on cash flow and know your costs, know what to measure and monitor, and do it frequently. So, and that's basically a lot of what we do, is help business owners figure out what are those key metrics. You know, you got guys like him who just flood you with information, and we have it. I mean, every business has got gobs of information. Question is it accurate? And is it telling me what I really need to know to keep my thumb on the business and manage the cash flow during a period of growth?
Thanks. Scott had earlier touched on kind of exit planning, but from your perspective, why is it important, and when should the entrepreneur business owner start it?
I think it was Dwight Eisenhower said, when I get ready to go to battle, a plan is worthless, but the process of planning is invaluable. And it's the same with exit planning. Having a piece of paper saying, here's all I'm getting out of my business, you know, is nice, but it's really the process you go through. I don't think anybody in this room thinks it's a good idea to start to do your estate plan because you think you're going to die this year. Most of us do that far in advance of when we anticipate we're going to die. And it's the same with exit planning. I guarantee you, if you own a business, you are leaving. You will exit the business. It might be horizontal, but you are leaving. And so it's important to measure what you got. What do I need when I'm ready to leave? How big's my gap? Start working on creating more value in that business, which typically is your biggest asset as a business owner. And know how you're going to get out, or at least 2 or 3 options. Neil Simon had the song, there's 50 ways to leave a lover. There's only 8 ways I can think of to leave a business alive. You're going to sell it to a third party, sell it to a family member. You're going to sell it to your employees. You're going to sell it to your business partner. You're going to sell it to your employees through an ESOP. You'll do an initial public offering. You'll liquidate it, which is the worst option because you don't get any money out of that. Or you decide to hire professional management and just milk it until you do die. But that's, and dying owning a business is an exit strategy. We don't like to think about it. So it's important. And so I always just tell business owners, if you're a procrastinator like me, just wait 2 years before you're ready to exit. So if you can predict with relative certainty when you're going to die, become disabled, get a divorce, get in a dispute with a business partner, be approached by an unsolicited buyer, the economy turns down, technological or sociological factors obsolete your business. I mean, if you can figure that out, then wait 2 years before that date. Otherwise, start now.
All right, so speaking of exits and starting now, when you get there, what kinds of attributes are the buyers and investors looking at, and what might bring the best offer?
Let's take 2 businesses. They look identical. Same revenue, same cash flow, same size, same industry. One of the owners takes 12 weeks of vacation. He's got a freezer full of walleye, and he's a 3 handicap. He spends the winter in Arizona, just kind of checks into the office, by phone. And the other business, just like it, the owner works 70 hours a week. He can't even go to the bathroom without holding his laptop or his cell phone. He does everything in the business and makes every single decision. Which one would you like to buy? I can guarantee you the first one will command a much higher price to a buyer because they don't have to go do what that second owner is doing in order to produce the results. And so the number one thing you can do to grow value in a business and what attracts buyers is a stable, motivated management team. And the business can operate without you. You become disposable, irrelevant. Number 2, we talked about it earlier, good, fundamental, documented processes and systems. How do we buy? How do we get new customers? What are our HR processes? How do we manufacture our products? Get those things documented, find the weaknesses, and fix them. Third is a stable customer base. If 90% of your business is to one customer, nobody's going to buy your business. They might buy it, but it's all contingent on whether they keep that customer or not. You need a realistic growth strategy and hopefully some sort of record that it's actually working instead of the story you're going to tell my buddy the banker. You actually can prove that you've got a strategy, it's written, and it's starting to work and you're growing the business. Effective financial controls. Anytime a buyer is going to come in, they're going to say, well, show me your financial statements. Are they accurate? We'll prove it. So, having the accountant looking over these financial statements, either a compilation review or an audit, to add credibility to the numbers on the story you're telling. And then a good and improving cash flow. And I use another example on cash flow. 2 businesses, and they each have generated $6 million of free available cash flow the last 3 years. One of them has generated $2 million a year for 3 years. The other one generated $1 million, then $2 million, then $3 million. Which trend do you like? I mean, obviously that growth in cash flow is going to attract a lot more buyers than something that's kind of flatline. Even though I take $2 million a year, but still, it's So people, buyers, private equity, strategic buyers are going to look for a growth pattern. So those are the things that we think add business value and create that premium sale price, unless you happen to have a patent or a phenomenal brand, or you're the big gorilla in the market and nobody can compete with you. But most businesses don't have that.
Great. Thanks, Tom. Okay, Kevin, your firm has certainly experienced significant and explosive growth. What are some of the things that kind of surprised you along that path and your business journey?
One thing I thought of actually up here, listening to Scott, was that we really, a couple of years into our business, we really need to get our paperwork in order. We filed what we needed with the Secretary of State and then went to work. So things like that really did. But what really surprised us and continues to surprise us is the opportunities that come along with rapidly growing a business and having a successful business. And we've talked a lot up here about planning and making sure you know where you're going and having a plan to get there. But it's also important, we found, to be very flexible and agile at the same time, because if you're only focusing on exactly the direction you thought you were going to go, you're going to miss out on all of these opportunities that present themselves along the way. Within the past couple of years, Renters Warehouse, we've turned into somewhat of a technology company in the fact that we actually own real estate technology. We've done joint ventures with people in technology. We've opened a very successful franchising side of our business. And all of these things came about simply because of the rapid growth and success we'd seen in business. And had we been focused solely on doing a fantastic job managing properties, we would have missed all of these other opportunities that came across along the way. So very surprising there of keeping that path and vision very important, but also being flexible and open to new opportunities that present themselves along the way. I see a hand going up.
I have a question about how you choose them amongst the many opportunities that come your way. Because how do you make sure you're not following a distraction instead of something that's really going to hit you?
It's a good question. We have a management team of about 8 people that are really integrated in a bunch of different areas of the business. And when these opportunities come about, they're not presented with the ownership of the business or 1 or 2 key people in the business. They're really vetted out throughout the entire organization. And we look for ways where they're strategically beneficial to us, or how that's going to help us grow, or how it's going to be more competitive. And then also, if it's something where we're merging with somebody or going through an acquisition process or trying to bring a couple of components together, it really ends up being a culture fit between the two, our business and either the new idea, software, service we're bringing on, the acquisition we're doing. Is it a culture fit? Did the people fit? Is the management similar? And is it complementary to what we do? We got into the technology business because we rely heavily on technology to leverage that to manage more and more people's property in an efficient way that makes it affordable for people to come use our services. And we were relying on, you can probably speak to this, 25 different software as a services probably at some point. And being able to hone that into just having 1, 2, 3 that we can build off of was important to us. So we partnered with someone and later bought them out and have a company called RentFeeder, which allows us to syndicate our listings out. We're building agent dashboards there for all of our agents in the field to be able to run all of their CRMs through, speaking of CRMs and things like that. So we just find things that complement what we're doing, and it's a slow process. We try not to jump at all the shiny objects. And touching on that was really my third point is, and it's not always the new ideas that really make your business better or make you grow faster, but it's selling more of your best-selling product. It's soft innovation. It's not always the big innovative new ideas, but innovating what you're already currently doing really well and making it better through the use of technology or through finding the weaknesses in your service offering or your product and making it a better product. And we learned maybe 5 or 6 years ago to really play in our own sandbox, meaning I think when we went through the introductions, I mentioned we manage single-family homes, townhomes, condos, and lofts. We really don't do much multifamily at all for a reason. We're really, really good at managing single-family homes. That's what our service is around. That's what our processes are around. And multifamily is a completely different animal. We thought about getting into that business, but there's plenty of opportunity for us in our very specific niche of our service sector. And we stay there. So playing in your sandbox and not getting distracted by all the shiny objects around the room that you will come across is important.
Did you run into any trouble other than the shiny objects? Were there other things that kind of got you off track?
We ran out of family and friends to hire, frankly. When we first started, it was a couple of us, and we grew and said, "Oh, we need to hire someone for this." So, Tom is an awesome friend of mine. Let's have Tom come work for us. Great. That worked for about a year and a half, and then we ran out of family and friends, at least that we trusted, to come work for us. So, recruiting has been and always will continue to be a big component of what we do and a trouble, and we've tried to, what I've learned is, one, always be recruiting. So whether you think you need to hire someone or not, always be recruiting. And if you find someone who you think is a great culture fit for your business, who aligns with your core values, who you see a great, you'd love to have them on board, but you just don't have a place yet, bring them on board and find a place for them. But always be recruiting is important. And then fostering a culture where people want to come and work is also very important. At Renters Warehouse, we've won countless 20-plus best places to work in the Twin Cities Awards, from the Twin Cities Business Journal to the Twin Cities Business Magazine, Star Tribune, you name it. And those are proud as a business owner and a business leader that our employees love coming to work, but they're also a great recruitment tool. When people come in the door and ask why they should come work with us, we can tout the fact that people love coming to work where they are. And so focusing on recruiting and making a great place to work. And that doesn't have to be cheesy stuff. It just has to mean that you've got a culture that really people enjoy coming to work, are all important.
Great. Any other questions? We got one over here, Richard.
What are you doing with respect to small, medium-cap enterprises and employee incentive, having equity, ownership, interest, membership, shareholders, and what kind of formulaic buyouts, share evaluation, unit member evaluation are you using, and with what success with our corporate system the way it's done?
The question had to do with employment incentive type plans with regard to issuance of ownership and how we're going about valuing those.
Yes. And then how you litigate later.
Well, that might be the next panel.
Yeah.
What I think I heard was, if you have employees, you want to incent them.
Right.
From a legal perspective, what kind of structures might you incorporate so that you can keep people on your team and help people, become owners?
Well,
How do you value units? Remember, what kind of
Okay, well, valuation, actually, that's a whole separate subject matter, and actually, Wes and I will do a panel on that in a couple of months. But the valuation thing is kind of a secondary issue. I think the bigger thing is, what's the platform to give ownership to employees so that everybody's incented in the same direction?
one of the questions I'll ask the business owner is, why do you want to, is the having an ownership the primary purpose, or is it providing a mechanism to provide upside for the employees? So if the main reason really is to provide some upside rather than having legal ownership interest, then we look at alternative plans, such as your phantom stock, or some type of a plan that will mimic ownership through a formula, or maybe it's not a formula. Maybe it's you have an appraisal at some point, but it runs parallel to the business, the legal part of it, but they are going to get some upside and share in that growth. That's one way. If it comes down to, no, they really need to have ownership, then that's another much more expensive and complex mechanism. And with that, we look at maybe it's issuing non-voting interest, those types of things. I get the sense I'm not answering your question, but...
Okay, well, two things. First of all, just pre-selling here, March 26th, Upsize Magazine and Club Entrepreneur will be doing a panel on the M&A activity strategies, and we certainly can touch on valuation on some of that stuff. As it relates to valuation, I'd be happy to try to help you with that, because that's some of what I do. From an investor standpoint, what I would say from ownership and trying to get ownership into the hands of employees, their stock option pool, and certainly the venture capital industry uses that significantly with almost every company that we're into. So that's kind of the world that I've run in and what we've done to help bring employees into the ownership mix. I have a question or time for like maybe one more question, maybe two, depending on how long. Anybody else have anything? I see one here.
Yeah, we're, every time we start a new client relationships, we spend a half a day doing a business diagnostic, and I'll offer that. Give me a business card, we'll get it scheduled. It's about 400 qualitative questions and then some financial analysis, and we basically look under the hood and tell you what we think about your business and what we think you need to do to make it better and stronger and faster. We also have some advertising-free collateral. It's all educational material out on the front table. Feel free to grab some on your way out.
All right, so one last one.
Maybe a question for Kevin. Have you had a scenario during your growth where early on you have the right person in the right seat, maybe on a management team, and they're the right person to drive your $2 million firm, but when you get to the $15 million mark, you realize that they're not that right person, and if you want to move to the $50 million mark, they're absolutely not going to be the right person. Have you navigated that challenge, and if so, give us some insight.
Absolutely. There's the old adage, I think, that the people who got you where you are aren't necessarily the ones who are going to get you where you're going. And that speaks exactly what you're asking about. And yes, we have. And what we found best is generally if you have that thought of this person who's either leading my sales or my current CFO or whatever it is, did a great job getting us to $2, $3, $4, $5 million, but they're certainly not the one who's going to get us further. They're probably feeling the same thing. And it goes to having open, honest, and candid conversations with people. And we've relocated folks on our team to a different position. We've had a few people leave, but they've generally all been good conversations. If you're thinking it, if you're feeling it, they probably are too. And so it can go one of two ways. How do we get you the education and what you need to help grow with us? Are you willing to commit to growing with us, or do you want to do something else? And it's really just those one-on-one conversations are important to have, and have them early and have them often, and combat it that way.
I would agree. If they're a good employee and they have helped you, you owe it to them, to be honest, and have that dialogue. And I would agree, most of them are saying,
Most of them know. Most of them know. And there's also a point where you finally get, I've found in growing a business, there's always a big gap between the talent I want and the talent I can afford. And we finally just recently got to the point of talent we can afford. And but there's also there's something to be said about somebody who's grown up in the business with you. They really know your business a whole lot different than the person who you really think you can afford and bring in. So you have to always be constantly weighing those options.
Okay, so two quick things. There's a little slip of paper on your tables here. This will get you out of the parking garage. If you forget it, just tell them you're at this event, but it works better if you bring this with you. And then to close from a panel perspective, what's kind of one takeaway that you'd leave with the audience, but we're bumping up on a time, so 30 seconds per answer. What's kind of the one thing that you'd leave with everyone? Well, start down here. Scott?
Really develop and work with your management team. Take the time to be proactive in your planning. Communicate the strategy and the plan throughout the organization.
Perfect.
I would say look for ways to avoid unnecessary complexity. As you grow, growth involves change, and change can lead to complexity, and some of it is healthy and good, and some of it is unnecessary. And if there are ways to simplify your business, that is always a good idea. And one good place to look is your rank and file employees. They usually have some really good insights into what they're currently doing that makes absolutely no sense and drives them nuts. and if you did nothing more than pay attention to that, have a system in place to get reliable, honest feedback like that, you can avoid complexity and everyone's happier.
Great, thank you. Dan?
Delegating and elevating has probably been one of the best things I've ever done. I made a promise to myself starting in January to not do anything I suck at anymore. That's quite a few things. And I thought I got it all off my plate. I hired a CFO, I have an assistant I'm very grateful for, and somebody who really runs the company for me. And the best thing I ever did was get out of the way and let these people do their jobs, and they've really done an excellent job, and I've been freed up to focus on the things that not only I enjoy, but I'm good at.
Great, thank you. Kevin?
I think it's important to mention that you mentioned the same thing that he just mentioned, which was figure out what you're good at, delegate and elevate, surround yourself with good people, but mostly find a way to have a plan for yourself and your day, your week, your month, where you don't get caught up in the whirlwind, but you actually are able to focus on doing things on your business, building your business, building some strategy rather than in your business all day long, which there's a big distinction, but it's tough to do.
Great, thank you. And last but not least, Tom.
I believe it was Thomas Edison said, good fortune happens when opportunity meets with planning. So plan your work and work your plan. Work on your business, not just in it. Thanks.
Great, thank you. Thank you.